Welcome to Urban Hood, your learning platform. Hello, and welcome to the Urban Hood Money Podcast. It's a fact that we need money to enjoy life and focus on the things we really like. That's why this podcast is all about money. And we teach you how to save money, grow money, and protect money. I am your co-host, Ali Buyan, and I'm here with Mushi Buyan.
Hello, how's everybody doing today?
In today's episode, we're going to be talking about personal taxes. You will learn about deductions, how to save tax, how to deal with investment losses. Stay tuned, we have lots to cover. I'm excited to introduce you to our guest speaker today, Rajesh Shah, who is a CPA at Dollar Tax Savers in New Jersey.
Hello everyone, good afternoon.
Thank you, Rajesh. So before Rajesh come in, we are going to share with you personal tax. So next hour with you. But Rajesh is going to give us some tips, some of the guidance, and you can take actions on timely manner. Plus, make sure you understand wash rule. So what is it? Some of you may have a stock in your short-term or long-term portfolio. You might have a loss. How do you take advantage of it? So I wanted to give a quick overview about wash rule before I hand over to Rajesh. Be familiar with it. What is this wash sales? Wash sale is when you buy a stock and you have it in your account within 30 days. Know that 30 days the transaction. Within 30 days, you have a loss and sell, you are not buying back. So there are the time criteria 30 days, then keep it holding and then sell it. And if you buy it back again, then on the same account, all this transaction has to be within the same account. Let's say you have a stock and that stock you have it in your short-term account, means day trading or your swing trading, you're doing it, but on your 401k, that same account you're buying it, you thought, oh, it's a good deal. Let's say you bought Tesla, and Tesla, by the time you bought it, it was $1,100. Now it's like around $900. And oh, I'm lost in tax season. Maybe I can take some tax credit. But you're buying it on your short-term account, and then you're selling it on the short-term account, or you have a loss, but you end up buying it on the retirement account. You'll not be able to take advantage of that wash sales. So be very familiar with it. And is it good? People ask, is it good wash sales? It is a good technique if you use the timing right. So you are going to get a lot of more details later on when the Rajesh is going to be sharing his content, but be familiar with it. And also know that, today's session, as you are going to be trader or investor, you are going to have scenario is not going to work for everybody. We all do tax filing, doesn't mean that we all pay the same tax, and everyone has a different situation. You may have one kid, 2 kids, 3 kids, or you have some other the responsibility in your family, or your situation is not, you're married, divorced. Depending on your situation and age and the income you make, loss, your return also different. So this is why it's always good to rely on someone professional.
I thank you, first of all, everyone, to spare a time to join us. I am a certified public accountant working as a tax consultant, accounting advisor, and also a public notary in the state of New Jersey. We are going to have a brief discussion about the contents of the Form 1040. As Mushi said, that this is totally going to be focused on a personal tax return, individual tax return. But of course, that we are planning certain other webinars relating to the business tax filing, business tax planning as well, right? So that is going to be announced very shortly. Now, in our today's discussion, here are the topics that we are going to focus. Basically, the brief introduction about the Form 1040, various deductions which are allowed, what are the tax brackets, certain tax saving tips, how losses can help you to save your taxes, and what's new this year. So Form 1040 is a US individual tax return. And they have certain schedules starting from Form W2 to Schedule E. Form W2 is basically showing up the wages income, your federal income, the federal wages, Social Security, Medicare wages, state withholding, federal tax withholding, and all this kind of the stuff. Then Schedule A of the Form 1040 is itemized deductions. That is what we are going to Schedule B is a interest and a dividend incomes. So like if you are investing certain money into any stock, and if you are earning any kind of the dividend, if you have certain time deposits with a bank from which you are earning the interest income. So this kind of the interest income, dividend income is to be shown on a Schedule B of the Form 1040. Schedule C, which is a profit and loss from the business. So if you are a sole proprietor or if you have a single member LLC, the net income from that business as a sole proprietor or as a single member LLC should be shown on a Schedule C. But in today's discussion, we are not going to have a detailed discussion on that because it relates to the business part of them, and that we will cover in upcoming webinars. Schedule D is a capital gains and losses, and Schedule E is a supplemental income and loss. Supplemental income and loss will include, like if you are a partner in any partnership, or if you own any small business corporation, then you are going to receive a K1, your share of income from the partnership or your share of the income from the small business corporation. So income from this K1 is going to be reported on a Schedule E. Also, if you own any kind of the rental real estate, if you have any rental property wherefrom you are earning a rental income, so you also need to show this rental income as well as the expenses related to the rental income on a Schedule E. So basically, there will be a wages income, interest dividend income, profit or loss from the business, capital gain, supplemental income like a K1 income and a rental income. So that's what is reported on a Form 1040 as an individual tax return. The aggregate of all these kind of the incomes, wages, interest, dividend, profit, loss from the business, capital gain, and the supplemental income, we can consider as a total income during the particular year. Out of the total income, you can either claim the itemized deductions or there can be a standard deduction.
So those are all the different schedules that can be filed with the Form 1040. Can you now go into some more detail about possible deductions?
So let's see what will be the standard deduction. See that the amount of a standard deduction much depends upon the filing status. Like if a person is filing as a married filing separate tax return or a single person, then the amount of the standard deduction will be $12,550 for the year 2021. If it's a married filing joint tax return, it will be $25,100 for this year's. And for a head of the household, that will be $18,800. So what does this mean? Standard deduction is nothing but a deduction about the incidental expenses. Like we earned the income, we earned the wages income, we earned the dividend income, we have a capital gains, right? But in order to earn this income, we also incur certain expenses. Like to be very simple, we can say that going from home to the workplace, coming back from the workplace, certain commute expenses are incurred. And there may be other certain kind of the incidental expenses. But if you are a wage earner, such actual expenses incurred, like for example, from traveling or commuting from home to the place of work and coming back from place of work to the home, they are not specifically allowed as a deduction, but they are indirectly compensated to the taxpayer in the form of the standard deduction. So standard deduction is nothing but a kind of a incident, a kind of a deduction towards the incidental expenses. So this standard deduction reduces your total income. And when income is reducing, of course, that is also reducing your amount of the tax.
Let's say when you have this singular standard deduction, that 12,550, right? What are the items can go? I know you mentioned about few things, that your travel expenses to commuting expense, correct?
Correct. Yeah.
What other expenses can go into it?
Like you can also take them as your personal expenses, day-to-day living kind of the expenses, right? So they are all covered, deemed to be covered under this particular case of the standard deduction.
Right.
So there is no specific, kind of the expenses that which can be, that can be expressly allowed to you by way of a deduction. But this is a minimum deduction that you are always able to get towards this kind of the incidental expenses.
So some of us have our young ones, let's say they are still in college or in high school, or they just got out of college, they don't make too much money, but there is still a single and not married. So they can take advantage of this 12,500 deduction, correct?
Correct. Yes. So they can also take advantage of this $12,550 as the deduction. So let's say that there is a single person who makes like $18,000 by doing some part-time work or job or any other kind of the stuff.
Right.
So now out of $18,000 in a year, 12,550 will become the standard deduction. Wow. Right. So only remaining amount on he or she will be paying a tax only on the remaining amount of the income. Let's say 18,000 minus 12,550. So let's say on a $7,450, he or she will be making a payment of the tax.
Nice. So by the time we are done, then you're going to, I think we're going to make a plan. Some others who asked me, hey, we are a stock trader. How can you save money on that, on the capital gain and others? But this is even though that this person who does who makes 18,000, if he or she does some stock trading, they can take benefit from it also.
By taking the amount of the standard deduction, definitely they can take the advantage for that. Yes.
For here, right away, 18,000 minus 12,500. This is like you have about 5,000 something that you are going to pay tax for income, taxable income showing up on this person, correct?
Yeah. And even, that there is also a room for a tax planning here. Like, let's say that a person is earning $18,000. So, and out of which 12,550 is not taxable, we can say, in the form of the standard deduction. We assume that it's a single filer. So still there remains a net income of $5,450 on which that person will be supposed to make a tax payment. Now, if you want to legitimately save the amount of a tax, put that amount 5,450 or let's say $6,000 into the traditional IRA. Put that money and you save the tax. So you at a time you are saving a tax as well as you also put the money into the IRA and you also save the money.
That's great. Thank you. Okay.
So Deepak here, you are talking about, you can claim deduction based, you can invest in your IRA, right? And you claim deduction on top of that. Is there any minimum or maximum salary which is restricted? Like if you make a certain amount, you can't claim deduction on IRA?
Yeah, see, IRA, we are going to take this discussion in upcoming, slides.
Yes.
So at that time, definitely you will be able to know that what are the thresholds and what money you can put into the IRA and everything.
Yeah. Thank you, Deepak. Yeah, let's just hold on to IRA. Now we are talking about standard deduction. So somebody asked here that Rajesh, that can a child who is working be both a dependent on the parent's tax return and also steadily or separately file their own taxes? I think they meant to separately their own
taxes. They can separately file their own taxes. Correct. Yeah.
So this person can be a parent's dependent plus they can file their own tax.
They can also file, yes. And they can also file their tax. Correct.
So then they can take a standard deduction.
Yeah, they can definitely take the standard deduction.
Awesome.
Yes. And let's take another scenario. Like a person who is a single person makes, let's say, only $12,000 in a year, right? By way of wages. So you know that out of $12,000 that he is making, already there is a $12,550 as the amount of the standard deduction. So we can definitely say that his tax liability is going to be zero. Without any kind of the IRA requirements or any other kind of the investment, he is not going to pay, he or she is not going to pay any kind of the tax.
Wow,
right?
This is
But
really cool.
yes. So in that case, still they are making a money. So you can motivate your child, to invest this money into certain kind of the, kind of the savings. Like they can think of making a Roth IRA. See, Roth IRA, there is no tax deduction, and they don't need the tax deduction at this particular stage because their income is already below taxable. So they don't need it.
Now you're ahead of me, Brajesh. I told you that we are going to have a plan. Someone who makes 18,000 is still young.
Yeah.
And then see, we already know it saved this person 12,550 single,
Yeah.
and it's not married and has about 4,000, 5,000 the taxable income. But Roth is coming next. By the time this person is going to walk out with the paying nothing to Uncle Sam. But
yes.
Somebody just mentioned here on the chat that someplace he read that a child they return. You can pay the child when they turn 12 for household jobs, etc. Can you please elaborate on it and how it helps or affect the taxes? If child will need to file his own taxes or stay dependent on parents' taxes, or any effect of the taxes for payments who are paying him?
Basically in that case, like if you own any kind of the business for a business expenditure purpose, you can make a small payment to the child, and a child can also show that as an income and put that money into the IRA and not paying a tax on that. Within the limit of the standard deduction, you can always make a payment and the child will not incur any kind of the tax liability on that. As I said, that child can continue to remain a dependent on the parent, and the child will be filing a separate tax return for them. And within the limit of a standard deduction, there is not going to be any kind of the tax liability. Or if there is going to be, then you can think of, putting the money into the IRA or Roth IRA, depending upon the situations.
Awesome. Thank you. Last one for this topic, folks. Thank you, everybody. But I'm going to read this one, Brajesh, and then we'll move on to the next topic. So does a side hustle by a child selling items on eBay, anything like to it, constitute earned income for which the standard deductions can offset? Is there an issue of self-employment tax?
Yes. So like when you are selling any stuff on the eBay or Amazon or any other kind of the platform, so definitely yes. So this is constituting a kind of a business to be carried on, or which is being carried on by a child. And he need to report this income on a Schedule C, the business. And definitely when you report any income on a Schedule C, there is going to be a self-employment tax.
Awesome. Thank you.
But one more thing I would like to tell. However, this thing I am going to cover in a business webinar separately. After Donald Trump introduced the TCJA, the Tax Cuts and Jobs Act, they introduced a qualified business income deduction. In a simple language, I can say that let's say a person had a gross income by way of a sales or fee, let's say $10,000. Okay. Now, let's say that there are $6,000 the amount of expenses that he incurred for his particular business. So there is a 4,000 net income coming from this business.
Right.
So in a layman language, I can tell, of course, there are very detailed rules for that. See, entire $4,000 of the net income is not completely chargeable to tax. Qualified business income deduction is equal to 20% of the business income, meaning only 80% of the net income will be really taxable. So you make $4,000, but you are paying a tax only on a 80% of 4,000, meaning you are paying a tax only on a $3,200. So that is a special deduction which has been granted, called as a qualified business income deduction. Yep. But we will have a more elaborative concept on that in a business webinar later.
Yep. Thank you, Brajesh. Lastly, before we move on, someone just asked, can you differentiate a single with MFS? You have either married with a married filing, or you have a head of household. If in that situation, head of household, and taking 18,800 the deduction. So yeah, if you can just, okay, in this scenario, this person, let's say you have husband and wife, maybe the wife is not working, only husband is working. Can he or she, or can he or she, whoever the partner is, can take advantage of 18,800 single standard deduction in that scenario?
Yeah, so there are certain specific rules under the IRS. What is defining the head of the household? So let's say I can give you one simple example that there is one person, say divorced or a single person, and taking care of the parents, and parents are becoming, that kind of, the dependent on that. So in that kind of the exceptional situation, you can be considered as a head of the household, and you can definitely get this higher amount of the standard deduction in compared to the single, like $18,800. But yeah, there are certain detailed rules regarding the head of household under the rules under the IRS.
Right, great. Yeah, thank you. Let's move on to the next.
Yes. Next is an itemized deductions. Itemized deductions or standard deduction. The previous slide, yeah. So either the amount of a standard deduction or the itemized deduction, whichever is greater, will be allowed to you by way of a deduction. Now, let's say that I am filing a tax return as a married filing jointly. So my amount of the standard deduction will be $25,100. But if I am trying to itemize, I have a medical expense, I have a state and local income tax, I have a mortgage, I made a charitable contribution. But when I make a total of all 1, 2, 3, 4, it came to $30,000, $30,000. So then either 25,100 my standard deduction or 30,000 the itemized, whichever is greater, I will take 30,000 the amount of deduction. But let's say, assume that the total of my itemized deduction is just, let's say 24,000 or let's say $21,000. So in that case, I will get an advantage of a standard deduction. Again, after the introduction of a TCGA, very few people are able to really itemize the deductions, and most of the people are able to get only the standard deduction. Now, let's discuss one by one. First is a medical and the dental expenses. So, like there is a medical co-payment, there are a prescription drugs, there are certain other medical expenditure that you are incurring. So, I see that based on the discussion with a client that there is a misconception. People understand that whatever amount of the medical expenses they incur, they definitely get them by way of a deduction, which is not correct. Medical or dental expenses can be allowed to you as a deduction only if they are exceeding 7.5% of your income. I give you a very simple example. Let's say I am making $100,000 as an income. So let's first consider what is the 7.5% of my income. That comes to $7,500. So as long as my medical expenses are not exceeding this $7,500, I do not get any deduction for the same. So let's say I spent $6,000 on a medical expenses. No deduction for me because it doesn't exceed 7.5% of my income. But if my medical expenses are $8,000, then I will get only $500 by way of a deduction. So bottom line, that whatever you spend on a medical does not qualify for a 100% deduction. They are eligible only in excess of 7.5% of your income. Second, which is a great limitation imposed under the TCGA, that a deduction for a state and a local taxes has been restricted to only $10,000. So that includes your state income tax. That includes the property tax, right? So aggregate of these kind of the deductions should not be more than $10,000. And because of this limitation imposed under the law, most of the people are not able to itemize the deduction. So that is a great limitation. But just FYI, it's not a law, but it's a proposal under the proposed act by Biden administration that they are thinking of increasing this limit to $80,000. So in that case, yes, it will be good. If from 10,000 it is increased to 80,000 in future, then definitely you will have the itemized deduction, great advantage. But as of now, it is restricted to only $10,000 only. The third deduction you are getting is a mortgage interest. On a principal residence, when we are borrowing any mortgages from the bank, only the interest portion will be allowed by way of a deduction. Also, the charitable contribution, that is also allowed by way of a deduction. Now, as I said, that if your total amount of the itemized deductions are less than the standard deduction, then definitely you are getting a standard deduction. So people come under the wrong impression that they are not getting any advantage of making a charitable contribution, which is not correct. Now, even though you are getting a standard deduction, then also you will get additional deduction for a charitable contribution. And that additional amount of a deduction will be $600 for a merit filing joint tax return. But in case you are not taking a standard deduction, you are able to itemize, then you can get a higher amount of the charitable contribution based on the actual contribution that you are making. Charitable contribution will include both cash as well as a non-cash. So like you are donating a cloth, you are donating a food. Yeah. So the reasonable value of that can also be considered as a part of the charitable contribution. And it is also eligible for the purpose of the deduction. Let's take a question, if any, based on this conversation.
So, Rajesh,
Yeah.
we have members at Urban Hood that those who is members that we have currently over 200 members are paid members. And
Correct.
our membership starts some of the, when I say membership means the people who is doing stock trading or who doesn't do trade, they are, it start with like close to $29 a month to you can get up to whole year like $340 something. They do become a light member, and then something called gold is like around $800 and $1,400. So let's say somebody starts with $800 or $1,300, they become member with Urban Hood and pay that. Can the single person, can this person take the 100% tax credit for this like $1,300 service they're getting from us, and
Correct.
still support our cause? And at the same time, it also helps them to make money from the all the educational session we do for them.
Correct. Yeah. So whatever money they are contributing as a charitable contribution, if it's a single person, they can claim up to $300. And if it's a merit filing joint tax return, they will be able to get a $600 by way of a deduction. But these restrictions can apply for a $300 and $600 only if they are going to take a standard deduction.
Okay.
But if somehow they are able to itemize based on what amount of the expenses they are incurring on medical, state, local income tax, mortgage, and charitable contributions taken together, then definitely, yes, they can take a full advantage of whatever contributions they are making as a charitable contribution.
Right. So it looks like those folks, the reason I'm asking this question, that I know people come tell me, oh, you know what, I got TurboTax, I got HR block, I got this, that. And then it tell me I save this much money or I have to pay this much. Then I just told them, like, look, guys, it's all up to you. TurboTax is a software company. TurboTax doesn't know your situation. And that HR block, they are doing $19 or $20, whatever it is that you are getting that. And then you'll end up paying that. Think of that. If you want to have a shirt that's going to make you feel good, and having feel good knowing that it's going to last you for a long time, would you go and Walmart buy $9, $10 shirts that you need a shirt? Or you know that you need something that's going to last you long enough, and then same time you'll get that personalized service. You might go Banana Republic, you might go someplace else where it's going to meet your need. So this person who I'm telling you that he ended up spending more money later on, he came back, he said, you know what, I talked to so and so, and then I lost so much money. So that's what I'm trying to tell you guys, that don't just go by what HR Block or your TurboTax tell you. Working with somebody who's knowledgeable, like at this case, you see the Brajesh is mentioning that hey, there are different way you can save money. Why not you take advantage of it? But your situation, because your medical bill, you might have the other things going on that I don't know, right? Or he can tell you those scenarios if you work with him, somebody like him who is knowledgeable with the market.
Yeah, and one another thing that what I observe, that people think of going to an accountant, let's say always in the month of February, March, April only. This is not correct. You should approach your accountant in the month of October, right before the year end. October, November, December, these 3 months are best for a tax planning. See, if you will come to me in the month of January, I will not be able to do any kind of miracle or any kind of good job for you.
Yep.
See, I can give you a better tax advice for a tax planning, tax saving strategies if you come to me on time.
Yes.
You contact me in the month of October, November, December. See, today we are focusing only on the individual, but as an individual, the taxpayer, you also need a tax planning.
Right. So, Brajesh, somebody mentioned here, is there a deduction for charity that can be used along with the head of household deduction?
Yes, of course. Within the limit of that 300, 600, definitely you can get that.
And the other thing, what form do you feel to include charitable donation with your tax return?
And that is a Schedule A. That is a Schedule A, the itemized deductions. But if you are not able to itemize, then there is a special line item on a form number 1040, which makes you eligible to, that this specified amount of the charitable contribution deduction.
Right. So yes, and guys, just keep asking question again, reminding you on that the discussion. So by looking at it, we'll see which one is most. And comment. And Dr. Ashok mentioned something. And let me see, where do I see your question, Dr. Ashok? About AGI. Can I give to my son? No, that's not enough. Somebody mentioned, can I give to my son 15,000 and ask him to contribute for IRA? But we're going to get that, in during IRA discussion. But before that, what is the Dr. Ashok mentioned about an AGI? What about AGI? I don't see Dr. Ashok. If you can unmute yourself, go ahead.
I just comment on AGI because because he was talking about 7.5% of the AGI for medical expense. AGI is adjusted gross income. How do you arrive at that? Because it's not all the income. You have to adjust it, right? If you put a HSA account, you can deduct it. If you put
yes, you can get a self-employed deduction. You put IRA amount. You have any children education expenses. So there are certain adjustments which are made against the total income, and after these adjustment, the balance is considered as an adjusted gross income. Yes.
Okay, great. Yep. Yeah. Okay, let's move on. I know we are also.
There is also what's called as a charitable. What is that? Charitable CRT. What is that? Charitable Reminder Trust, right? That can you comment on that?
Basically, that is kind of that you can put that money with certain mutual funds or certain other kind of the companies, and they will do the charity. You can that in that case you want to accelerate or that to make a more amount of the charitable contribution. So like if you are earning a very good amount of money, you can think of putting that money into a special account And you know that as and when, according to your instructions.
That is called donor advised fund.
Yeah, donor advised funds. Correct. Yeah, that is called as a
So
donor advised
in the
funds.
donor advised fund, you can fund more money now, but not necessarily donate immediately. But you can
Correct.
donate
But
over
yeah,
a
you
period
can
of
hold these up. Yeah, you can hold
time.
this up. Like you put 15,000, you put $100,000 in a donors advice fund. But what's the advantage? That like this year, you are putting $100,000 to the donor advised fund. It does not mean that as of in this year, you are making a charity for $100,000. You just set aside that money, but still you become eligible to get $100,000 as a charitable contribution itemized deductions. Now in future, you are having a plan to do some charity to church, to some temple or any other kind of the stuff. So you give advice to the, you know, the manager of the fund, and they will release the amount of the contributions to any specified purposes. So yeah, that is also one another thing that we can consider. But basically, you know, that they are for a high income earners, but it is a good tool for a tax planning as well.
Right. Yeah, thank you, Rajesh, mentioning that. Some of you that who reached out to us also in the past or even in private, that hey, I fall under this category.
Yes.
So Urban Hood has the commercial part, which is the Hood Capital. But in the Hood Capital, we only work with investor category people. People who I say investor category means is one level up with accredited investors.
Correct.
There, you have to have a certain amount of money and cash reserve. But some of the fund, they work with us that, we can talk offline on this and how you can take advantage of that. For donor fund, you still have to work within an institution who by approved by SEC, who can take that money and just, with your direction, set up the trust and save you tax money. That ties with also when Abdul mentioned at the beginning that everybody is thinking now in this market. What was his question? How to lower capital gain taxes against trading gains, means stock trading. So this is one of the method that you can put in your toolbox that you might be able to apply. All right. Again, this is not going to be applied to everybody, but
yeah, it depends upon the situation of person.
Fall into that investors category.
Okay, so now we've looked at our income and our deductions, and we've established what's our taxable income is. What's the next step?
Determine the taxable income, then comes the tax brackets. These are the tax brackets for a single merit filing joint. From it will range from 10% to 37% based upon the income thresholds. So even this can be even equally important tool for a tax planning. Like let's say a person who is filing a joint tax return, and let's say without just an aggregate amount of the salary income for husband and wife, or let's say they are coming to $95,000, or let's say they are coming to $91,000. So if it's $91,000, they will reach to the higher tax bracket, which is 22%. So here we can advise them, you put $12,000 to IRA, 6,000 for you, 6,000 for your wife. So in that case, your income will become below 81,000, right? So you can save another 10% of a kind of the tax. So if you know the tax brackets, and again, if you come or if you approach your accountant well in time before the December 31st, and to do some kind of the calculations to know that what can be your tax liabilities, how you can change the bracket by doing a legitimate tax plannings. So for that, you should be aware about this kind of the tax brackets. Any question on that?
What is the tax bracket to contribute to IRA? You said 6,500 is the amount, but what is the tax bracket for that? Can you repeat that if you don't mind?
No. It was only a kind of the tax planning I was talking about. Like if you consider the 12% rate of a tax, correct? For a merit filing joint, up to $81,050 of the income, your tax rate will become 12%. That's what I'm saying. Okay. But let's say for any merit filing joint couple, the gross income, I mean, their income was $92,000. Okay. So they exceeded 81,000 category. So when they exceeded 81,000 category, they will go to the next bracket, which is 22%. Correct? So how you can do the tax planning? You can think of putting the money into the IRA. Like husband will put $6,000 to IRA, wife will put $6,000 to IRA, $12,000 they will put. So out of 91,000, 12,000 minus. So it falls below 81,000. So instead of paying a 22% tax, by putting the money into the IRA, you can pay the 12% amount of the tax. So that will definitely help you reduce the amount of tax. So in that case, I would always suggest that think of tax planning ahead of the times. Don't approach or don't contact your accountant in the month of April, right? So you should approach the accountant always before December 31st so that you can get a proper advice. Even see that one more thing I can tell you, that like most of the individual tax payers are simply not only having their the wages income. They might have like a rental income, you have a capital gains, right? Now what the issue is, like let's say you are having $100,000 as a salary, you also made another $50,000 in a capital gain. Now what happens, that if you do not contact your accountant, if you don't tell him well ahead of times that, hey, I am estimating that my capital gain will be $50,000 this year, then you are losing here. See, you have paid a federal income tax, state income tax only on your W-2 income. But in spite you made a $50,000 in the capital gain, you haven't deposited any tax in advance with the IRS. You need to make the estimated payments. So if you fail to make the estimated payment, right, then there can be some penalties which is imposed by the IRS. So you are at that time you are paying unnecessary amount of the penalties to the IRS. So you should be always well prepared. You should give proper estimates to the accountant well ahead of the times. Ask him to get the estimated tax payment vouchers, make estimated tax payments on time to avoid any kind of the penalties from the IRS. Moreover, even at a state level, same thing happens. Let's say you filed the extension, right? But you did not make the sufficient estimated tax payment. In that case, your extension is automatically denied by the state. And they will also charge you the penalty, not only for making an underpayment of the tax payment, also for a late filing of the tax payment. See that your extension has been denied by the state in that case.
So I have a quick question, sir. When you're saying approach accountant before the December 31st, how will you manage that? Because you said only IRA 6,000 per husband, 6,000 wife. So what are the other deductions what we can make if we made any capital gains? That is the first question. Second question is, when we do the rental income, is it good to have personal or do we need to have through LLC?
Yeah, see, LLCs are also a pass-through entity. Ultimately, it is flowing through your personal tax return. But advantage of LLC is that in addition to the rental real estate expenses, you can claim certain other expenses by way of a deduction. So in that case, I suggest to have the business under the name of LLC rather than a personal. And so far as the managing is concerned, that you just need to give the estimate to the accountant that is what I am planning. See, you give him your, that latest pay stub until like November. So as an accountant, I will know that what is your wages income till date, right? How much taxes have been withheld. Now, if I add up the capital gain, what could be your amount of tax? How much is underpayment? Then I can advise you that how much additional amount of tax you need to pay. So that's all an accountant can do. You just go to the accountant, give the estimates, ask him to prepare the estimated vouchers, and definitely he can help you.
Thank you.
No
and also you said that under 81,000 we will come into 12%. After 81,000 is 22%. Correct. So if I earn 140,000, so first 81,000 is 12%. Next remaining amount will be 22%. Of
course, yeah. That's why it is called as a bracket. So even like for a first 19,900, you will pay only 10% tax. Then from 19,901 to 81,550, you will pay 12%, and then on additional amount you will pay 22% tax.
So but if you can, up to what amount it is 22%, sir?
170 to 750 for a merit filing joint tax return.
Okay.
Yeah.
After that is 30%?
Then it is 24%.
Okay.
Up to 329,850.
Thank you, sir.
Mm-hmm.
So I can approach you before 31st and you can plan for me, because whatever I have the accountant, when I talked to them, he said that let's look into the when we file the tax. So that's what I'm getting the accountant.
You missed the train. That means you missed the train.
That's what I'm glad that you asked this.
See, we are very much proactive. You won't believe that we are contacting our every single client in the business, and we know that he is having a capital gain, he is having a rental real estate, and we have completed the tax planning, estimated voucher work almost for more than 75% of our clients as of today. It's done. They started making the payments.
And also, do we have separate? So you will do business and also personal, or you will do only business?
Both.
Apana, yeah, just those who join later also, just please remind you this. Today's session is mostly personal tax, not business. We will do business tax in next. Those who still want to take advantage of business tax, that Brajesh has his contact is shared earlier, and later also he's going to be share his contact information if you want to work with Brajesh. If you want to work with other CPA, you're welcome to do so. We do not want to say do not work other people, but at least by joining here, get enough knowledge so you can make informed decision. And you can we want you challenge your CPA, that when somebody said, hey, your CPA told you, oh, we'll come back after next year. And that is the reason that I told you that before I started working with Brajesh, that I had to get rid of a lot of CPAs that they're not looking at my best interest. They're looking at their own fees and then saving money and so on, and move on to the next client. You do not want to be just any number.
So this tax bracket is basically applied after itemized deduction. I mean, like,
yes, that is applicable on a taxable income. Correct. Yes, after all the deductions, itemized deductions, and that IRA contribution that you are making, 401k you are making, whatever. So this is applicable on a taxable income.
So in your example, which you shared earlier, like 92,000. So from that 92,000, first we need to apply the deduction, which is 25,000 something, right?
Correct. But what 92,000 I was referring to is a taxable income. But of course, yes. Like if it is your gross salary, yes. After all the deductions, correct. You are right.
Okay. So it means the 92,000 you were referring is after deduction of 25,000. It means someone is making like 120, 124 in your example.
Correct.
Okay. Well, second thing, if let's say suppose if a person is making 100,000 and then 50,000 capital gain, which contains not only from the stock but also from the cryptocurrency.
Yes.
How can we reduce that capital gain from that? I mean, like, because mostly you get the tax information from your broker at the end of the year. How can you estimate before during the planning phase?
Yeah, see that you at least should have a knowledge that for what price you had purchased this stock and what price you are selling it. So at least you can make a rough kind of the estimate that approximately, let's say 50,000, let's say 75,000. So at least we are able to give you some reasonable estimates than doing nothing. Yeah. So at least pay some amount of the tax based on that, and you get rid of the penalties. See, most of the clients, when they are approaching me first time, they started talking that we have been paying the taxes and we do not save the tax. But that's the reason. You approach your accountant at a wrong time, right? So that's the thing.
So with this wash sale rule is also applied on the crypto as well?
Yeah, that is we are going to discuss today. Yeah.
Okay.
If I may add, regarding the gentleman that asked a question about capital gains on your trading or crypto, you can go to your account and whoever you're trading with, they have either cost basis, or you'll say something to reference to your account as far as what your current capital gains profits are. You can estimate. It'll show you including wash sale and exclude wash sale, and it updates on a weekly basis. You can check that today, and you'll know what your profits are or losses are for the year, and that's going to reflect short term and long term. So definitely that up.
Yeah, that can help to get the proper estimate.
That's a lot of information to process. So I think a quick summary is in order. After we determine our deductions and our taxable income, we check the tax bracket table to find out what percentage we have to pay. However, what you've been stressing, Rajesh, is that maybe more can still be done with tax planning to ensure that we remain in a lower bracket. But we have to talk to you about this in, let's say, October or November or December, and not wait until we're actually filing our taxes. Moreover, if we have investments with capital gains, we may have to pay penalties if we wait until we file taxes to declare them. What you're saying is that we need to talk to you or any other accountant during the tax year to come up with an estimate and start making appropriate payments in order to avoid paying late fee penalties during our tax filings. That's a pretty important piece of information right there. Do you have any other tips on how to reduce our tax bills?
Of course, he does. Let's go, Rajesh.
Okay.
So here is the maximum limits for our contributions to the IRA, 401k, health saving account, flexible spending accounts. So that is reducing your income. That is helping you to save the amount of a tax. So even based on the age limits and certain other thresholds, you can also make a catch-up contribution, additional contribution. For example, if taxpayer is 50 years and above, they can make an additional contribution of $1,000 to the IRA. So let's say there is a person who is of 45 years of age can make only 6,000. Let's say the person is of 52 years of age can make $7,000 to the this amount of the IRA. So again, that will be helping you, to save the amount of the tax by putting. But even, that these briefly have been taken care in my example of 92,000, putting the money into the IRA. Yeah. So 401k, health savings account, and flexible spending accounts are also the another options which are available.
So Brajesh, so based on this person we are talking to, or we are creating this fictitious character, let's say, yours daughter, my daughter, same age situation.
Mm-hmm. Correct.
Made 20,000, or what did we say, 18,000.
Correct. Yeah.
They can they made that standard deduction or took the advantage of and has a 5,000 something that they have to pay tax. But now if they put that extra money in a Roth benefit,
in a traditional IRA, then definitely they can have no tax liability.
Yep.
Let's say 18,000 minus their amount of the standard deduction, 12,550. Again, they put another 6,000 to say traditional IRA, no income. So
right,
there is no tax payable.
So this is where sometimes, that your software cannot do this for you guys. It's just have to use some expertise with the people who has been doing it for years and get their input and make sure, you help them to make the right decision. So this person, let's say we are talking about it still has time from between January till March or the April to put the fund that a traditional IRA or Roth IRA, whatever it is, that way they can work out zero tax, correct?
Yes, I can give you one more thing, that you have a time until the extended date of filing the Form 1040, which is the 15th of October. So it means that you have until 15th of October 2022 to invest this money into the IRA.
So you see that it's amazing. We are not even teaching them, or also some of us are not thinking, hey, what other way we can do legally, ethically, and morally, right? Just
correct,
be careful on that.
Cool. Can I ask you a quick question?
Sure.
This spells the FSA, that is a flexible
spending account.
Spending account.
Mm-hmm.
Is the employer contributes it?
Yeah. Basically, this is something relating to only an employment. The employer-employee relationship, and this is something set up by the employer. So, when as an employee you are making a contribution up to 2,750, it is not taxable. Let's say my gross salary, right? My gross salary is $82,750. Now, if I'm supposed to pay the tax on 82,750, but if I'm putting 2,750 to FSA, then I will be paying a tax only on $80,000. For what purpose this is meant for? This FSA is spent for, that for medical expenses, like my medical co-payments, my insurance payment, my prescription drug payments, right? And I can make these payments out of the flexible spending accounts.
What is the difference between that and HSA?
See, HSA is basically a kind of a self-funded account. So for setting up the HSA, you don't need any employer and employee relationship. Just like you open the IRA account, you open the HSA account.
Okay, got it.
But you yourself cannot do the FSA account because this is something can be done only by the employer.
Brajesh, HSA account cannot be open if you have a PPO insurance. High deductible insurance.
Correct.
So only if you have high deductible insurance, you can keep an HSA. Correct. If you have a low deductible insurance, you cannot keep HSA.
You cannot keep that, yeah. So there are all for IRA, Roth IRA, 401k, there are so many other detailed rules, right? But we are, that at a glance, we are able to explain you that these are the tax kind of the strategies.
Yeah, if you are under certain income and above, you cannot.
Yes.
Brajesh, what amount we can keep on what do you call that IRA and Roth IRA? Roth IRA after taxable income. If the marriage filing income, if it is 170,000 or 200,000, can we keep 7,000 in Roth IRA?
See, Roth IRA is basically not giving you any tax deduction in the year in which you make a contribution. Right? That's basic difference between the traditional IRA and the Roth IRA. So in a traditional IRA, in the year in which you are making a contribution, you will become eligible for the deduction. But once you will withdraw that money after the retirement, then that income will be taxable to you. Roth IRA, you are not getting any kind of the deduction, meaning you pay the tax on that income. But when you will withdraw at the time of the retirement, there will not be any kind of the tax. So far as the amount of the contributions are concerned, it depends upon the age threshold. So can you put 6,000 or 7,000? Can you make the catch-up contribution will depend upon the age threshold.
And also, what is the income we can keep that, Rajat? That's what I'm asking, not age. Suppose 6,000 I'm eligible to keep. So if I have earned 200,000 as a family income, can we keep 6,000 or is there any threshold?
Yeah, like for a married filing joint tax return, like for you and your wife, you can put total $12,000 together. But at that time, there are also certain income thresholds that also be taken into consideration.
What is that income threshold?
Of the hand, I do not remember that, but there are certain thresholds that should be taken into consideration.
If you make more than whatever the amount, you cannot pay.
Correct. Yeah, that's a threshold. Yeah, so that is mentioned as a threshold. Correct.
So if you are making, just a question, if you're making more than certain amount, so you can't claim this IRA deduction.
You are right.
Or even 401k deduction also?
Yeah, 401k, it is up to $19,500. And that is something which is set up by your employer.
Yeah, that's fine. But if you're making more than a certain amount, can you still claim 19,500?
You can, yes, you can still claim 19,500. Yeah. But even along with the business tax planning, these tools are really very important. And if you have any business, then definitely you can, have more deductions based on the incomes and everything. So definitely you can maximize, but that is more applicable to the business side.
I know for IRA, it is, if you're single, it is 75,000. If you're making more than 75,000, I think, it's not, you can't claim a deduction.
Correct. Yes.
We've talked a lot about income and gains so far, but unfortunately, people are also losing money on their investments. Can you explain how that impacts our taxes?
So even we can also talk about the earned income credit. Basically, that is for the low income earners. And if you have any earned income, then you can get a refundable credit from $1,500 to around $6,700. But it depends upon the family size, your filing status, your income, earned income. There are certain different kind of the criterias. See, basically, like I have observed that since the last stimulus, there were some people that who did not receive any kind of the stimulus for some reason, and they started filing their tax return just to claim the stimulus money. But in that case, they should not only file to claim the tax return only to claim that kind of the stimulus money, but if you had some kind of the small income, like you are having a small business and you made, let's say, $5,000 to $6,000 as an income, you better report it to the tax return, right? And when you report it to the tax return, don't report like a zero income. You have earned the income, you report it to the IRS. Yeah. And if you have being all these criteria being fulfilled, then you can become eligible for this good amount of refundable credit. So that is also a good to get higher amount of the refunds from the IRS. When there is a capital loss, for a merit filing joint tax return, you can claim only up to $3,000 per year of the capital gains, the amount of the capital loss against your income. Let's say in the year 2021, someone had a loss of $15,000 on the capital stock loss. Now, if you are filing a joint tax return, out of that 15,000, you can claim only $3,000 in 2021. But it does not mean that remaining $12,000 have lapsed. You can carry it over to the next year until and unless this loss is fully covered, right? Now, that there is a wash sales. So like if you sell any securities, or say if you only bought any securities, then you are selling it for a loss. Again, you are buying it within 30 days, then this loss cannot be allowed to you by way of a deduction. So in that case, you should be careful that you at least wait until another 30 days. On a 31st day, you repurchase that security, then it is fine. Then wash sales rules are not applicable to you. And you can claim the amount of the loss by way of a deduction. But when it's a cryptocurrencies, it will be just taxed like a stock, long-term, short-term, and all the same rules will become applicable. But in case of a cryptocurrency, wash sales rules are not applicable. Wash sales rules are applicable only for the stock, not for the cryptocurrency.
Crypto for this year, they're going to come up with that.
Yeah.
Yeah, the Dr. Ashok, this year, but now we're talking about what it is 21, right? We're ending up. So until SEC has a new regulation, let's keep it what we have in front of us.
Correct. Yes.
Can you please explain the crypto rule? I mean, please elaborate. I mean, with example, let's say I have a crypto, which I'm lost right now. Can I take a loss and buy at the same price? Then what would happen? I mean, I already made some amount in the previous month. I mean,
yeah, I can give you one example that I purchased one stock, let's say for $1,000, right? Then I sold it for $800. So there was a loss of $200. Now in 29 days, I repurchased that security, that stock. Okay. So I cannot claim $200 the amount of the loss. But now assume that it were not a stock, but it was a cryptocurrency. Then I can claim the 200 loss amount of the deduction because the wash sales rules are not applicable.
Okay, so it means I'll give you my situation. So basically, I have some crypto which I'm in losses right now. Can I do this strategy for 2021? Because I bought it, let's say Bitcoin at around 65,000. I'm just taking a hypothetical example. Now the Bitcoin is at around 46,000. Can I sell those crypto which I bought at 65 right now and book a loss of like $20,000 and buy today at the $46,000? Would it help me to offset my previous gains within the year which I made during the
Definitely.
year?
So as long as the wash sales rules are not applicable. So otherwise, otherwise it is just like a stock then. The only distinction that to the stock, the wash sales rule will apply. So here you do not have this kind of the limitations applicable. So yeah, you can take the advantage of the same.
Okay. So one more thing, and if I have a multiple accounts, like multiple brokerage accounts, so I have a account in the Coinbase, I have account in the let's say
Yeah,
Robinhood.
it doesn't matter. All the gains and losses are aggregated on your tax return.
Okay.
Yes,
So
yes.
Brajesh, one thing I know as a stock trading, the wash rule applies on the same account whenever you do this, because when they do audit, they need to look at your transaction. Let's say you have an account on different and same stock or crypto, you bought it, your time cycle is on different account, they will not give you the wash sell.
Because there are different accounts.
Because different account, exactly. That your trader, remember, your broker sent 1099 to you. In that 1099 that you did not meet within the time frame, they have wash rules rule. So hence you are going to get penalized with that breaking the wash rule
wash sales rules,
rule, right? So this way, if somebody said I have multiple account, it did it. Nope, it did not happen. That's the reason it's important to know wash sell, how it works. It has to be within the same account.
Moshe, if you have three accounts, okay, as the gentleman is telling, it's always aggregate, because in this account, let's say you sold it and you bought it back within 30 days, that will apply and you're not going to get a credit. But let's say you sold it and you did not purchase for 30 days, then you can take the loss in this account and also in the other account.
Yes.
Also other account, because all of that are going to be aggregated for the accounting purposes when you file the taxes. And as far as crypto is concerned, basically this year is a good year to take you can sell before December 31st, and then you can buy it back. Whatever loss you had will still go along as a loss, because it does the wash rule does not apply.
Yes, right. That's why there is no, what I meant to say, like, again, guys, I do not want to confuse you or tell you that there is no black and white rule that, what I know.
It's about, the next thing is about additional child tax credit. We know that under the American Rescue Plan Act, now people have started getting, certain payments from the IRS at a monthly amount, let's say $250 a month, $300 a month, depending upon the, the age of the children, right? So that's nothing but advance payment of the child tax credit. Now, end of the year, everyone will receive one letter from the IRS. I think the letter number will be 6419 or something, not exactly sure about that. And that will mention that until 31st December, how much payment you have received on account of the child tax credit. And that is something you will need to provide it to your tax preparer. And based on that, he will be making a proper presentation of the child tax credit. If you did not receive any such amount, then you will be able to receive it against your amount of the tax refund. So that's about the additional child tax credit. About what's new this year is the charitable contribution. This is something we already discussed, that deduction limit will be $600 in case you are not able to itemize. If you are able to itemize, then these deduction limit restrictions will not apply to you. Also, as you received in the last year, 2020, there were any recovery rebate credit. That is nothing but an amount of a stimulus payment. So, you know that in the beginning of the year 2021, every one of us received $1,400 per person as a stimulus check, but there are still few people who may not have received the stimulus money. So in case it is not received, you will be able to claim it along with your tax return for the year 2021. And one more thing, that for the year 2020, the unemployment compensation was exempt up to $10,200. But now this exemption is no longer applicable for the year 2021, and it is going to be fully taxable. So that are the three things which is new this year. apart from, that all the other provisions under the IRS. So if you have any further questions or need a consultation, you can reach out to me via email or phone that is mentioned. You can also visit our website for various services that we are rendering, and we can definitely schedule a consultation call based on your requirement, because you know that every person's situations are going to be different. So if you want any advice or any consultation for us, definitely feel free to reach out to us.
Yep. Thank you so much, Brajesh. And here his website is in www.dollartaxsavers.com, dollartaxsavers.com, and email is V as Victor Shah at dollartaxsavers.com, and phone number is 848-667-3670. What else you think that it could help you? Our focus was today giving you some ideas so you can take it with you to do your personal tax. We will have business focused in January. Just stand by for more details.
Hi, Rajesh.
Yeah.
Just one question. What is the difference between if we are trading, like using a company account and trading, or individual account, so we can avoid the tax?
Yeah. So like basically it's a kind of a tax planning, no tax avoidance. Yeah. So with this, any stock trading done in the name of the LLC, you will be able to claim certain amount of the expenses. Like very simply, I can explain you, if I continue to same example that I had purchased a stock for $100, like, and now I am selling it for $1,400. So I am making a $400 as the amount of capital gain, right? But if I do it under the LLC, and if I versus I am doing as a personal, right? So if I had done only personal, no LLC, I am paying a tax on a $400. But if you do the LLC, then there are certain expenses, you can claim certain expenses as admin expenses, office expenses, these, that, right? Which are legit, which are legally allowed to you by way of a deduction. So that can further help you reduce your amount of the tax with doing under the name of the LLC.
Okay, that's perfect, right? So we can do using the LLC is good, right?
Correct.
Yeah, thank you very much. I appreciate it.
So, Brajesh, there is a question that I think this person may asked earlier, but his scenario, he or she's scenario is my employer provided me relocation benefits, for example, 1 month hotel stay. Since this is taxable, the amount my company spent for my stay would show up in my taxable income. Can I take deduction for that? What's your opinion?
See, as an employee, you do not have any other kind of the deduction for a relocation or something like that. So that will be simply showing up to you only as an income.
So this is why sometimes we recommend you folks who is doing in stock trading or other thing on side gig on the hustle, that you do it under a business name, and then this way you can take some of that advantage. I'm not saying expenses. That this is not the case that I'm saying you can do it, but it's always advisable to have some business on the side, even LLC, so you can take some other business expenses.
We deal starting from a personal and business tax returns, multi-state tax returns, tax planning. That is a very important aspect. We do the accounting, bookkeeping services. If there is any IRS audit, state audit, then definitely we provide the help to resolve all their kind of the tax notices. We also expertise in a expert kind of the taxation with foreign bank accounting report, business formations, and all other different kind of the services.
Thank you so much, Rajesh. That's all for today. Thank you for listening, and we hope that you learned something new and useful. If so, please like us and share with your friends, family, and colleagues. You can visit us at urbanhood.org to check out our courses and live seminars and learn how you can join us in our live and interactive talks. We are active every day. Everybody deserves financial freedom, and when it comes to money, there's always something new to learn. Please join us again for another episode.